Hello and welcome to the Mehmi Group podcast. I'm your host Haider Malik, and today we're tackling how to survive high costs in trucking with smart financing tactics for fuel repairs and insurance. Rising diesel prices, unexpected breakdowns, and steep premiums can squeeze your margins, but with the right tools, you can protect your cash flow and keep rolling. First, let's talk fuel costs. Fuel cards are designed for fleets and owner operators to lock in discounted diesel prices, earn rebates, and track spending in real time. You swipe your card at participating stations, and the program applies negotiated savings immediately. Many cards also offer volume based rebates, so the more you spend, the better your discount. To bridge timing gaps, consider a revolving fuel line tied to your business account or a specialty lender. You draw funds when you fill up and repay as invoices clear. Always set internal spending limits per truck and reconcile charges weekly to prevent surprises. Next, repairs can hit your bottom line hard. A sudden engine failure or transmission issue can cost thousands. To avoid large lump sum bills, use targeted maintenance loans or vendor financing. Many heavy duty shops partner with finance companies offering point of sale payment plans at rates often close to prime plus 1 or 2%. You spread the cost over 6 to 12 months while keeping your working capital free. For emergency breakdowns, an equipment line of credit gives you instant access to cash. Draw only what you need and repay as freight invoices arrive. This approach saves you from tapping into core operating funds. Insurance premiums in trucking regularly exceed $10,000 per truck per year, but you can smooth payments and reduce rates by negotiating with your broker. Ask for installment plans that split your annual premium into monthly or quarterly payments with little or no interest. You can also bundle liability cargo and non trucking liability under one carrier to unlock multi policy discounts of 5 to 10%. Maintaining a spotless safety record and investing in driver training programs strengthens your renewal position and may qualify you for further savings. Always explore telematics based pay as you drive options that measure actual usage so your premium matches miles driven rather than estimated workloads. Building and managing reserves is critical. Create a dedicated repair and insurance reserve by setting aside 1 to 2% of weekly revenue per truck in a separate savings account. This buffer prevents you from using core funds when unexpected costs hit and gives you breathing room to plan financing. Draw from this reserve first before tapping lines of credit or factoring, and then replenish it gradually as cash flow allows. For larger fuel expenditures, consider fuel hedging contracts through energy suppliers to cap your cost per liter over a defined period. Hedging locks in your rate and protects you from sudden spikes, but requires discipline to manage contract terms and settle volumes as agreed. Work with reputable suppliers and understand the settlement process clearly to avoid unintended exposures. Integrate these tactics into a simple cash flow plan. Use basic accounting or cash management software that links your fuel card portal, credit line statements, and loan balances so you can view your cash position in real time. Create a rolling 30 to 60-day projection of expected income costs and reserve balances. This forward visibility helps you anticipate shortfalls and arrange financing proactively rather than scrambling under pressure. Finally, negotiate with all your financing partners annually as your volume and performance improve. You may qualify for higher advance rates on vendor financing, lower fees on credit lines, and better rebates on fuel spending. Building a long term relationship with lenders and vendors positions you to secure the best terms and ensure your trucking operation thrives even when costs surge. That wraps up today's episode on surviving high costs in trucking with fuel cards, revolving credit lines, maintenance loans, vendor financing, insurance installment plans, reserves, and hedging strategies. By combining these tools into a layered safety net, you absorb cost volatility, keep your trucks moving, and maintain healthy margins to explore tailored solutions for your fleet or owner operator business. Visit mehmigroup.com and complete our quick finance form. I'm Haider Malik. Thanks for listening, and here's to surviving high costs and thriving on every haul.